If you follow my channel for any amount of time, you'll know that in most videos, I say that investing in life insurance is probably not the best option for the majority of Canadians. I usually say that that type of strategy is reserved for high income earners, wealthy individuals, and business owners in Canada. And so you guys have asked for it over and over and over again if I would make a video on how to use life insurance within a corporation as a business owner, as an investment. And so in this video, we're going to break down all of the basics of using life insurance in a corporation. What are the benefits? What are the drawbacks? What are some concerns that you need to have? And by the end of this video, you'll know exactly if you should be buying life insurance in your corporation or not. What is up, guys? For those of you new to the channel, my name is Philip Setter. I'm the founder and CEO of Affinity Life, where we've helped hundreds of Canadians find the right life insurance coverage at the right price, all from the comfort of their own home. If that sounds interesting, I'll put a link in the description and you can check that out. But without further ado, let's get right into this video. All right, so here's the thing about buying life insurance in a corporation as a business owner in Canada, and a little bit about this video. I'm going to try and make this video as high level as possible. So I'm not going to be getting into the super nitty gritty of how this works. The reason being is that it's just incredibly complicated. So I've been in this industry for almost 10 years now, and I've worked with a lot of business owners and I've worked with a lot of advisors. I built an entire curriculum that is just dedicated to teaching advisors how to structure these policies correctly. And I think it has over 20 hours of recorded content in it. So to try and jam pack everything that you would need to know about buying life insurance in a corporation into like a 20 or 30 minute video is super difficult. So I'm just going to try and go over the high level points. Of course, if you guys want information, just reach out or comment or get in touch with me or whatever it is, and we can figure it out. Or maybe I'll make more videos in the future. However, this video will be just a high level video. So if I miss something or if I don't go really deep into detail about something, it's just because I'm trying to make this as streamlined as possible and as high level as possible. Now, before we get into the specifics of how a corporation works with life insurance, let's just talk about invest in life insurance strategy in general. Okay, so when people say, hey, you should invest into a life insurance strategy or a life insurance policy, what they're typically talking about is buying usually a whole life insurance policy, sometimes a UL, although I really would not recommend using a UL for this type of strategy, just because when you have a strategy and it already has so many variables that come along with it. And what I mean is there's already so many things that you need to be concerned about, okay? Well, a whole life insurance policy is relatively guaranteed and simple, and it works very well within this strategy. So when you have this strategy that has so many different variables and you have a product that has some guarantees and some knowns, then I think that's a really good thing. But a universal life insurance policy also has so many variables and things that can go wrong. So when you have a strategy with so many things that can go wrong, and then you insert a product that has so many things that can go wrong, you can start to see that the problems just start to exponentially increase. And so how this strategy usually works is you buy some type of whole life insurance policy. And there's a ton of different ways that you can structure this. You can do a whole life 10 pay, 20 pay. You can do a whole life pay, where you pay for the entire duration of the life. And of course, you can do what's known as a premium offset, where you stop paying at a certain amount of time and the cash value starts to pay for the life insurance, or I should say the dividend starts to pay for the life insurance premiums. But there's a million different ways you can structure this. There's also ways you can structure it where you focus on having a higher death benefit, and there's ways you can structure it where you focus on having a high cash surrender value. So it's all how the advisor that you're working with is going to structure this and set it up for you. But the premise is that you would buy a whole life insurance policy usually, and with that you would have an associated cash surrender value. Now, this cash surrender value would also grow tax-free over time. So you'd have your death benefit that's tax-free, and you'd have this other component which is also tax-free. And you can think of this component kind of like the equity within your home. You couldn't just access that equity without doing anything. You would either need to sell your house or you would need to get a home equity line of credit. Well, it's the same thing with life insurance. So the cash surrender value within a life insurance policy is just like equity within your life insurance policy. So if you cancel your policy, they have to pay that out to you, or you can borrow against it and use that money to invest in other projects, such as other investments or in your business, or just use it maybe for retirement benefits or whatever you would like to do with it. But that's essentially a loan. loan. And there's a couple different ways you can structure it. You can get a policy loan or you can get a collateral loan. And so they each have their pros and cons. But the main premise of investing in life insurance is you have this policy which has a death benefit, which is great, okay? And the death benefit is usually growing over time, so it's getting larger and larger. And then you have this other component, which is growing tax-free as well, which you can borrow against for a multitude of different things. And when you do borrow against it, you're not affecting the future value of it. So it still continues to grow. Just like within a house, if you had a house and you borrowed against the house is still appreciating. And just because you have a loan against it doesn't mean that it's fixed in value. This is different from other investments. If you had, let's say, some mutual funds or stocks or something like that, and you wanted to take money out of that, well, you would be out of the market and you would be losing any gains that you have within that investment. So it's a way for you to stay invested in the market, have this death benefit, and then have this cash surrender value grow over time that you can borrow against for a multitude of different purposes. Now, you're probably wondering how this works in a corporation. Now, here's the thing. It works pretty well for an individual, just if they personally buy it, especially if they're a high income earner, it works very well because of that tax rate. However, if you're a business owner, this is where it really starts to make sense, because if you're a business owner, you'll know that your biggest, I shouldn't say your biggest problem, but one of the biggest problems or one of the biggest expenses you have in your corporation is taxes. And the tax rates within a corporation can be very low and they can be very high. You're probably thinking, Philip, what are you talking about? Okay. So the active business operations within your business, so whatever your active business is, if you're a construction company, that's you actually going out and doing the construction, that's taxed at a very low tax rate. And we have two different tax rates for corporations here with a small business deduction and the general rate. One is below $500,000 in net revenue. One is above $500,000 in net revenue. And those are relatively low. However, the third one that you need to take very special care of is the passive investment tax rate, okay? What is that? That's if you just have passive investments in the corporation, such as mutual funds or stocks or ETFs or real estate, and you're not a real estate company. That's where it can be as high as 50%. And this isn't like a tiered thing where it goes up. It's just basically 50% across the board all over Canada. Doesn't matter what province you are. I think it can go as high as 54%, but it ranges in 48 to 54%. And that's how much you're taxed on your investments. Now, the reason that they do that is because they know that you have more after-tax capital within your business because the active rate is so low. So they want to make it fair between you as a business owner and just a salaried employee. If he had taken a salary of, let's say, $200,000 or $250,000, they want to make it fair. So they're going to tax you very high when you have passive investments within your corporation. And then when you pay it out to yourself as a dividend, as a shareholder of the company, they're going to return some of those taxes to the corporation. And this is a very complicated area of tax, by the way. It's called refundable dividend tax on hand. However, all you need to know is the passive investment tax rate within a corporation is incredibly high. And now, what do I always say in my videos? I always say that when you compare this strategy against an RRSP, which is tax deferred, it starts to fall apart. However, when you compare this strategy against a tax rate at 50%, it really starts to make sense because it's all tax deferred within the cash surrender value. All the growth of that is not tax deferred, it's tax exempt. It's tax exempt. It just is going to grow in value without being taxed. And so when you compare that to any type of investment within a corporation where you're paying 50% tax, it starts to look very attractive. That's the first reason that this can be an incredibly powerful benefit. The second reason is when you start to build this cash surrender value within this policy, you can then take advantage of special tax deductions that are available in your corporation. So what are those? Well, one of the things that you can do is as this cash surrender value builds and grows, you can use it to invest it back into your business. And this is a very common thing for business owners because they're, expanding and they're hiring more people and buying more trucks and buying more property and whatever it is, the more marketing, more websites, more design, more branding, et cetera, whatever it is. Well, you can borrow out of this life insurance policy and you can then, pay an interest rate on, your loan that you got to invest back into your business. However, that loan and the interest that you pay is tax deductible to the corporation. So you can continue to borrow money out of this while it still grows, by the way, it's still growing in value. So you can borrow money out of it, put it into your business, get big tax deductions that offset huge portions of the actual cost of insurance. And then you can do that again the next year and the next year and the next year. So having life insurance in a corporation does afford you these luxuries of being able to get these special tax deductions that offset the cost of it. And in some cases can actually completely offset the cost of the insurance altogether if you are making enough income and you can utilize all the deductions that are available and you're actually using the loan to put that back into your business. That's the second one. Now, the third way that you can utilize this type of strategy within a corporation, which is one of the more common ways, is, here's the thing. Business owners, we don't have a pension. I'm a business owner, and if you're watching this, I'm imagining that you're a business owner as well. I don't have a pension. I don't have anyone that's going to take care of me during retirement. My business is my pension. Okay. So at the end of the day, we want to build assets within our corporation, and we're not taking maybe you are taking $400,000 a year, but I don't think so, because just the tax advantages of that are not very good. It's pretty tax inefficient. So what we typically do is we keep money within some type of corporation. And usually how I structure that with myself and also my clients is we have a separate corporation. We'll call this Investco. And that's where we're funneling all of our different profits from our different conglomerates and our different corporations. Now, this is our pension right here, this corporation. This is where we put our real estate that we want to invest in, our investments, our mutual funds, GICs, stocks, et cetera, and our life insurance. And now one of the ways that you can utilize this is during retirement or getting closer to retirement. Even if you sell off all these other corporations, you maintain control of this corporation. And then you can start to utilize this and pull an income stream from this. And how I explain this to clients is I say, you can use this as a buffer asset. And this is one of the most powerful ways to use this, because if you're still invested in the market, that's the thing. We're still going to be in fixed income and equities and bonds and yada, yada, yada. We're still going to be in these things. When you get closer to retirement, you're going to reassess your risk portfolio or your risk position. And what that means is, maybe you're going to say, well, I've been in these stocks that make 12% one year, and then they're down to like negative 2% the next year. And, this balance is, constantly in this flow, pardon me. And I want to be in some type of position where it's way more fixed. There's not so many fluctuations. However, when you do that, you are going to lose some of your returns. And so what I recommend to some clients is I say, hey, why don't you still stay invested in the market where you do get some of these swings? However, if you have a down year, if you have a year where it was, COVID 2020, or, some other year like that, 2008, something like that, then you can just wait. You can have this other buffer asset, which is this life insurance. And if you're in a, let's say, negative environment, -3, -5% return, don't touch that investment. Let it breathe, let it recover, let it grow back to what it was. Because if you take money, if you sell off assets in a down position, you're going to lose so much and the recovery is going to take way longer. So if you just let that breathe, and then you have this other asset class here, which is permanent life insurance, you can then borrow against it as a buffer asset during those times where your other position or your other portfolio, is recovering. So using life insurance as a buffer asset is incredibly powerful. And using it in a corporation can be even more powerful. Now, there's many strings attached to using it in a corporation and borrowing against the policy. So there's some of the ways that you do it. You can either borrow it corporately, and then the corporation has the loan and they could either pay it out as a salary or a dividend to you as the shareholder or as the owner of the corporation. Or the other way that you can do it is you can borrow it personally, and it is tax-free. However, I will say there is a lot of strings attached, and I'm not going to get into it in this video. There's a lot of ways, a lot of things, that you need to consider. There's a lot of things that can go wrong. Again, there's a lot of things that can go right. It can be very beneficial because you're borrowing from this tax-exempt policy that's grown, and you're also borrowing it tax-free, but you need to structure it correctly, I promise you, or a lot of things can go wrong. So that is the third main benefit of having permanent life insurance in a corporation. The fourth main benefit of having permanent life insurance in a corporation is in 2019, the federal government and the Federal Finance Department of Canada put forth new legislation that imposed these new rules where it starts to grind down your access to the small business deduction. And what am I trying to say? What do I mean by this? Okay. So like I mentioned, in your corporation, you have that the active tax rate, the small business deduction. That's a typically really low tax rate. It's like 9%, 10%, or 11%, depending on what province you're in. So you will want to maintain access to that because you have way more after-tax capital to redeploy back into your business. Well, this new legislation came forward and it said, well, if you start to have a surplus of passive assets in all of your connected corporations, doesn't matter where they are, if they're in the active company or over here, this other company, like they know what you're doing, okay? Then we're gonna start to grind down your access to this deduction or this small business deduction, this tax rate. So if you start to earn over $50,000 a year within all of your conglomerates corporation of investment income, so that could be, real estate, that could be interest, that could be dividends, that could be capital gains, whatever it is, then anything over $50,000 of earnings in your investments is going to start grinding down your access to this small business deduction. Basically, how it works is for every dollar that you're over $50,000, $5 will get subtracted from your limit. And in most provinces, the limit is $500,000. And so after $150,000, you have $0 left or zero access left to this small business deduction. It's gone. At that point, you're paying 100% the general tax rate. So that's not preferable because then we have way less after-tax capital to redeploy back into your business. However, permanent life insurance does not count towards this limit. It's tax exempt and it doesn't count towards this grind down, pardon me. And so if you are in a scenario where you're earning, that $30,000, $40,000, $50,000, $60,000 a year within your corporations of investment income, permanent life insurance could be a very good option for you to redeploy some of that earnings and some of your investment capital into this type of strategy because it doesn't affect it at all. And that could continue to grow tax exempt within the policy and not affect your access to this small business deduction in the slightest. And hopefully you can maintain it and you'll have way more after-tax capital to redeploy back into your business. So that's the fourth main benefit of having permanent life insurance in your corporation. And the fifth one, which is a little bit complicated to get into, but I do want to bring it up because it's a very, very, very powerful benefit that you have for using life insurance in your corporation. So this is kind of how it works. I'm not going to get into the nitty gritty because it's a little bit complicated. However, the way that life insurance works in a corporation and how it gets paid out to your beneficiaries, such as maybe your wife or spouse or children or whoever it is when the life insurance gets paid into the corporation, there's an equation that you need to know. And the equation is face amount, which is your death benefit, minus the adjusted cost basis of your policy equals the CDA. Okay, well, what the hell is CDA? CDA stands for Capital Dividend Account. And all a capital dividend account is just a notional account where you can pay tax-free capital dividends out to shareholders. And so what the hell am I trying to say? You're probably a little bit confused. That's okay. Here's the thing. At the end of the day, when you pass away and you have life insurance in your corporation should receive a fairly large capital dividend account balance. And this CDA is so powerful when used with tax planning in your corporation, because when you do pass away, you essentially have a large tax bill upon death. The shares of your corporation are deemed disposed of at their fair market value, and you need to pay a tax bill on this. However, when you combine good tax planning with the use of this CDA, this capital dividend account, you can massively reduce your tax bill upon death, massively. And I'm not talking reduce it in the sense that the life insurance will pay the tax bill. I'm talking just this special mechanic called CDA will massively reduce your tax bill. And there's numbers of different ways that you can structure it. You can do something known as loss carryback. You can do a redemption of shares. You can do pipeline planning. And I'm sure maybe you're not familiar with what any of these words mean. All you need to know is that if you work with a competent tax lawyer to set up your estate planning and a competent insurance broker to use life insurance within a corporation and get access to this CDA, you can massively reduce your tax bill. And this is above and beyond all the other things that I talked about. You can still leverage it and borrow against it and put it back into your business and have it grow and use it during retirement. You can do all of those things and you can still get the death benefit as well and use that, to pass that to your children or pass that to your spouse or whoever you want to pass it to, and still have this other benefit. Like, this is an additional benefit above and beyond. So it's an incredibly powerful tax planning tool that if you understand it, and I know I didn't really talk about it too much in this video because it does get a little bit complicated, but once you understand CDA, capital dividend account, it's just like, whoa, that's crazy. So that's the fifth main benefit of using life insurance in the corporation. Okay, so now that I talked about all the benefits of using life insurance in a corporation, there are some huge negatives that you need to be aware of. It's not all roses and sunshine. It's not all, oh my God, this is so easy. Let's just go and buy a whole life insurance policy tomorrow. There's a lot of things that can go wrong though, and I'm going to highlight a few of them right here so you know before you jump into this, there's some serious things that you need to consider. The number one biggest problem of permanent life insurance in a corporation is what corporation do you put it in? And you're probably thinking like, what do you mean? Just put it in the corporation. It's fine. Here's the thing about permanent life insurance and any life insurance, pardon me, for that matter, in a corporation. Permanent life insurance more specifically though, because there's so many more things that go along with it, is once you put it in a corporation, that's where it is. Like that's where it's staying. If you try to move a permanent life insurance policy out of a corporation, especially later on, especially like after 5 years or 10 years, there's so many taxable events that happen. There's a taxable event in the corporation that owns the life insurance. There's a taxable event wherever you're trying to move the life insurance. There's a bump in the ACB of the policy, which means you get less CDA out if you pass away. There's so many things that go wrong if you try to move life insurance out of a corporation. So when you are setting this type of strategy up, you want to make sure that whatever corporation you put it in is going to be the corporation that you still own at death, which leads me to another point within this though, is the planning that you do. And here's one of the things that you need to be aware of is in Canada, we have access to something known as the capital gains exemption, the lifetime capital gains exemption. And this is essentially where a business owner can sell off shares or dispose of shares of their eligible corporation, and they can get a tax-free capital gain up to like $1 million when they sell it or when they dispose of their shares. However, the eligibility criteria to qualify for this capital gains exemption is that you essentially, and again, I'm kind of, glossing over a lot of the details here because I'm trying to make this more high level. Essentially, all of the assets within your corporation need to be active, not passive. So life insurance is a passive asset. If you put life insurance, permanent life insurance specifically, in your corporation, that is your active business corporation, then you could lose access to this exemption, this capital gains exemption, which is a fantastic benefit. By the way, for each individual that's able to take advantage of this, it's a roughly $200,000 in tax savings. So putting life insurance in the right corporation is incredibly important, because if you're looking at permanent life insurance as a tax advantage, and then in the process of buying it, you lose $200,000 in tax savings, did you really save anything? So that's one of the biggest concerns about permanent life insurance, is which corporation you put it in. And 99% of the time when I'm doing this with any of my clients, the very first thing we do, we connect with a tax lawyer, or we use one that I'm familiar with, that I've worked with in the past, and we do a complete restructure of their corporations. We set up different corporations, we set up family trusts, we set up mechanisms to take profits out of the active business and funnel it over to another corporation that's totally separate from this active business, and we put it over there with the passive business. So making sure you don't just go out and buy permanent life insurance and put it in any corporation is very important. Number two, you want to make sure you have the ability to pay for the policy. Now, this isn't specific to a corporation. Of course, you want to have that ability no matter where you are, but more often than not, I shouldn't say more often than not, but definitely sometimes I come across advisors and clients, and they say, this is how it was structured. And it's like a large percentage of the net revenue of the corporation is going towards this type of strategy. I personally would recommend 10 to 20% of your net revenue to allocate towards this type of strategy. This is just like another piece of the puzzle. This isn't the whole puzzle. Insurance advisors will love to say, hey, you make $100,000 a year, put $90,000 a year into this policy. I don't agree with that. I think a really good rule of thumb, is 10 to 20%. If you're making $100,000 net revenue, 10 to 20,000 a year, that's it. If you're making $1 million, 100 to 200,000 a year. If you're making 10 million, 1 million to 2 million a year. It just goes from there. 10 to 20% of your net revenue, I think, is a very safe, conservative estimate and number to put into a permanent life insurance policy. And number 3 and 4, which I'm just going to lump into the same one because I'm reading my notes, but they're, kind of the same and they tie into each other. So here's the thing. As you probably got from this video, you'll see that it is a little bit complicated. There's quite a few things that need to be structured correctly. There's quite a few nuances, and you need to make sure that everything is done correctly. Well, how do you do this? There's a couple ways that you do this. So number 1, you want to make sure everyone is talking to each other. So you want to make sure your accountant, your tax lawyer, your investment manager, and your insurance broker are all on the same page. They're all communicating with each other. No one is working in silo and just trying to sell this one thing and, oh, I don't want to talk to the accountant, or, oh, I don't want to talk to the lawyer. Everything needs to be done together in order for this to be effectively utilized. Because if the accountant doesn't know what's going on, they're not going to be tracking anything. If the lawyer doesn't know what's going on, then, they're not going to make the right corporations or do a restructure. If the insurance broker doesn't want to talk to your accountant or lawyer, this is a huge, huge red flag. If any advisor doesn't want to talk to your accountant or lawyer and says, oh, they won't understand it, it's just that they can't explain it to the accountant or lawyer, that's a huge red flag. Do not work with that advisor because he's just trying to slip something under the rug. And there's so many pieces of the puzzle that need to be managed. If he or she, if they're not actively asking you to talk to your lawyer and accountant, that's probably not a good thing. I would probably search for another one, which leads me to one of the biggest points of this type of strategy is the advisor. You want to make sure that you're seeking out and finding a very competent advisor who works in this space regularly. And you want to see if he has resources that he's done, other business owners that he's worked with. Does he have lawyers that he's working with? Does he have accountants that he's working with? You want to see past work that he's done, and you want to make sure that he understands exactly how this works down to a T. That's the first one. The second one is you want to make sure he's going to be in this industry long term. He or she, whoever it is, as an advisor, that they're not just going to be selling this and then they're going to be out of the industry, because these are very complicated things. And you want to make sure that when you actually need to utilize it during retirement or taking a loan or, investing it back into your business, whatever it is, they're going to be there to help you. So preferably, I would try and find someone that's, up and coming, maybe their 30s, 40s, or 50s, something like that. I probably wouldn't be looking at an advisor in his 60s and 70s if you're a business owner that's in your 50s or 40s, because unfortunately, when you start to utilize this strategy, unless they have a very good succession plan and they're passing it down, to the next advisor in line, or they have, someone else taking over the business, they're going to be dead by the time you actually need to use this. So take some time. Don't just, fall into the very first advisor that you find. Interview a few different people. See how long they've been in the industry. Are they solidified in the industry? Have they been in there a long time, long enough that they're not going to quit the next year? Are they still relatively young, that they're going to be in the industry when you actually need to use this type of strategy? You should take some time and make sure that whoever you pick is the right person to help you implement this strategy. So in conclusion, permanent life insurance and incorporation can be a wonderful tax planning opportunity. There's so many different ways you can structure. There's so many things that are really good about this, but of course, there's so many things that need to be managed correctly. So again, it can be incredibly good, but it needs to be managed correctly and implemented correctly, or there's so many things that can go wrong and you can lose a lot of money. So make sure whoever you pick is going to manage all of those things and put you hopefully on the right path. And, hopefully you can, get something like this implemented, save a whole bunch of taxes, and have this awesome asset during retirement. So with all that being said, if you guys have any questions, just drop them in the comments below or shoot me an email. And if you guys are enjoying this content, all I ask is you give it a thumbs up, and I'll see you guys in the next one.